Welcome back to Power Lunch. Time now for our three-stock lunch. We're trading some of Wall Street's top picks for 2023. Mizuho is naming Robinhood a top pick in financial technology. Goldman Sachs calling Bath & Body Works a best mid-cap idea. And Evercore ISI naming Netflix a best idea for the new year as well. So with us to break it all down is Chris Grisanti, Chief Equity Strategist at MAI Capital Management, a guy who knows all about stocks and all about these kinds of valuations. Chris, if you will, let's start with Robinhood. The question here is whether or not this company can recover from the pandemic highs to the pandemic lows that we're currently at right now.
Well, you're asking exactly the right question. I mean, this is a post-COVID hangover stock, and there's a lot of those, including Bath and Body Works, which we'll talk about in a minute. But really, Robinhood is a bull market stock, and we're just not there anymore. There's still a lot of froth in the customer base, Tom. Of the largest 10 holdings of Robinhood customers, GameStop and AMC and NIO, the Chinese battery companies in there. So it's hard to grow a sustainable business on that kind of customer. Now, they'll say they want to do a cash app like Venmo, but that's a crowded field too, and with players that are a lot stronger than Robinhood. So I'd look elsewhere. I don't like the risk reward here.
And Chris, just to follow up on that one, how big in your mind is the crypto part of the Robinhood story as opposed to the stock trading part?
Well, I think you mentioned a good point. However, I'm a little contrarian there because I do think crypto is not done and down for the count. I think it's having one of its, semi-annual or biannual 70% pull down. So that might actually work out okay. I just don't think the business model of Robinhood, which is focusing on young, small accounts, is going to work as these account holders get more wealthy. I think they're going to go to a brokerage firm with more services and a deeper bench.
All right, Chris, it's Kelly. It's great to see you again. Let's move along.
Kelly.
Hi, and let's talk some Bath and Body Works.
Sure.
What do you do with the stock?
Well, this too is a tough way to make money. It's another post-COVID hangover stock, and there's so many of them, like housing, like Amazon, and some of them are real opportunities. And Kelly, you and I have talked about housing before, but I do think this is a tougher one. Sales are slumping at the same time that Bath and Body Works has to get their margins up. So that's a really tough dynamic to get your margins up as sales are going down. Now, as your viewers may know, third point, that the activist investor has gotten involved, and they have some heavy lifting to do. They're troubled by the executive comp at Bath and Body Works, and they should be. But I don't think that's going to clear up the problem, even if they fix that. I would use the stock went up a bunch when Third Point announced their entrance about a week ago, and I'd use that upturn as a way to take profits there. I really would.
All right, and the final part of our three-stock lunch is a name that has recovered tremendously off the lows as of late, at least for right now, and that's Netflix. This is a stock that's rallied some 70%, I want to say, off the lows that we've seen just over the past several months here. Netflix, you could call it a blue chip name, Chris, at least when it comes to tech, media, and telecom. Is this one that you want to own for 2023?
Yeah, of the three, I really do like the Netflix. And you have to be careful. You're absolutely right. It's come awfully quickly off the bottom, although it is down from $700 a share. Look, the streaming battles are clearly raging, and Netflix has been hit hard. And like a whole bunch of tech stocks, from Google and Amazon on down, they need to switch from the growth mode to the cost savings mode. The biggest change that Netflix, of course, is making is to an ad-supported option. But here's the key. What a lot of investors don't realize is that Netflix will actually end up making more money on the ad-supported subscribers, even though they're paying less, because, of course, of the ad revenue that's going to be brought in. So as that works its way through the system, one, I think they'll add subscribers, and two, I think investors will be pleasantly surprised by the top-line revenue growth in a tough tech environment. So Netflix would be a sleeper for me for 2023. I like it.
Chris, before we go, thoughts on the market as we head into the Fed meeting this week. How do you feel about things overall here as we look to close out the year?
Probably more optimistic than consensus, Kelly, which frankly wouldn't be hard. I mean, I think we can see the end to Fed hikes from here. I think we've got 2 or 3 more in the offing, but we're getting there. And as long as they don't go beyond 5.25, even 5.5, I think we'll be okay, because I don't think earnings are going to be crushed like some more pessimistic pundits are saying. So I think if earnings can hold up okay, they can slump a little, but not a lot. I think we could be set up for a decent market with low expectations. So that's a good thing.
All right. That's Chris Grisanti with the 3-Stock Lunch from MAI Capital. Thank you very much, sir. Have a happy holiday season.